Welcome to lesson number 5, Advanced Stock Rental Strategies. Now that you understand how to rent your stocks and why people want to rent your stocks and how to identify great rental stocks, it's time to explore more advanced stock rental strategies. In this lesson, you will learn about what I consider to be the 3 most important advanced strategies. Please note that the following names represent titles I've created to help you better conceptualize each strategy. Therefore, they do not reflect the nomenclature normally found on Wall Street. If you speak to your financial advisor, he or she most likely won't recognize these strategy names. Number 1, the roll down, also known as the parachute. Number 2, the roll up. And number 3, wait and see. Let's start with the roll down, also known as the parachute. This strategy helps us compensate for those times when one or more of our 3 guidelines for identifying a great rental stock have failed us. Recall from lesson number 3 that a stock's 52-week low, its current ratio, and its price to book value ratio help us spot great rental stocks. Essentially, the roll-down strategy is our primary emergency response plan when, despite those 3 criteria, we find ourselves stuck with a stock that continues to underperform. Let's watch the roll-down strategy in action. Let's say that you bought shares of ABC Company at $20 per share. You then rented it, or more accurately, you wrote a 1-year covered call for $5 in rent at a strike price of $20 per share. In essence, your break-even price per share is $15. That is $20 minus $5. But then suddenly, the stock price of ABC Company plummets to $13 because of a serious earnings miss on Wall Street. Investors that failed to rent their stock out to other investors are now down $7. You, however, are only down $2. Which is the difference between your break-even price of $15 per share and the new stock price of $13 per share. While being down $2 per share on paper isn't great news, at least you are wearing your rental parachute and still have a good chance at salvaging your investment. Any investor that didn't rent out his or her shares just went skydiving without a parachute. Remember, renting stocks to other investors is about mitigating risk. At this point, depending upon your interpretation of what caused ABC Company's stock price to drop and the company's outlook going forward, you can either sell your stock and realize a $2 loss, or you can choose not to sell it and rent it out yet again. Renting it out again is like strapping on a brand new parachute. If the stock price drops yet again, you're somewhat protected. But if this is truly the stock's bottom, and it begins rising again, you might not only recoup your $2 paper loss, you may still earn a nice profit. Whether you decide to sell your stock or keep it and rent it again, you must first close out your previous rental agreement. Otherwise, you can't do anything. So how do we close out our previous rental agreement? It's easy. We simply buy back our covered calls. To buy back our covered calls, we must choose the same number of options contracts, the same strike price, the same expiration date. But this time, we select Buy to Close rather than Sell to Open under the Order Type menu tab. Recall from lesson number 2 that when we rent out our stock, we choose Sell to Open. Now we must Buy to Close if we want to terminate our rental agreement. Once we do this, we will be unencumbered and able to either sell our shares at the current market price or rent out our shares again. Here's the best part. Because the stock price in our example dropped so dramatically, from $20 all the way down to $13, the same covered calls we originally sold for $5 each will most likely only cost us pennies to buy back. Think about it. How many people believe the stock will climb back up to a $20 strike price, let alone the renter's break-even price of $25, that is, the $20 strike price, plus the $5 in rent they paid you? The answer is no one, because it seems so unlikely renters are only willing to pay pennies for that same covered call, which means you can probably buy it back just as cheaply as they can. Okay, now let's assume you want to hold on to your stock and rent it again, even though it dropped from $20 per share to $13 per share. Perhaps you're a contrarian and feel strongly about the stock's chances for a rebound. Let's recap. You started by paying out $20 per share. You originally collected $5 in rent. The stock crashed to $13 per share. You are now holding on to $5 in rental cash, your first parachute, and a $13 stock. So far, you're only down $2. That is $5 plus $13 minus $20. Everyone else is down $7. As we mentioned a moment ago, you can now buy back your original covered calls for pennies and rent the stock out again at a $15 strike price for $3 more in rental income. Now you have $5 in cash from the first rental plus $3 in cash from the second rental. That equals $21 in total assets. Now you're up $1. Remember, you originally paid out $20 to buy the stock, so now you're up $1, even though the stock crashed. And your new break-even is now $12 per share. That is $20 minus $5 in rent minus $3 in rent. If the stock price stabilizes and your new renter decides to exercise his or her call option, you would get the $15 strike price, plus you already collected $5 plus $3 in rent. So you would earn a total profit of $15 plus $5 plus $3, or $23, minus the original $20 you paid for the stock equals a $3 profit, or 15%. That is a $3 profit divided by your initial $20 investment to buy the stock. Not a bad escape before you started losing any money. Recall that you were up $1 after the stock dropped to $13 per share and you rented it a second time. In that scenario, your new break-even is $12 per share. If the stock price does drop again, you have the same alternatives as before. You can choose to sell your stock or rent it yet again. Every time you re-rent your stock, you are putting on a new parachute. Basically, your parachutes, each rent and re-rent, protect you from free falling to the ground. Okay, so now you know how to protect yourself if your stock is dropping in price. But what should you do to maximize your profit if the stock not only stabilizes, but suddenly starts rising again? That's where the roll-up strategy comes in. Basically, it's the opposite of the roll-down technique you just learned. The roll-up strategy dramatically increases your chances of keeping your rental stock indefinitely, for as long as you like, even if your strike price has been exceeded and your renter plans on exercising his or her option to buy your stock. Hey, wait a minute. How can you do that? That is, how can you stop your renter from exercising his or her right to buy your shares? Well, you already know the answer. You can always buy back your covered call. Remember? Instead of selling to open, now you simply buy to close the same covered call with the same strike price and the same expiration date. That's it. An even more important question is not how, but if we should terminate our contract. That is, does it make financial sense? To answer that question, we need to continue our example from earlier. Recall that in the previous example, we were up $1 when the stock crashed to $13. You were holding on to $8 in rental cash, $5 plus $3 in rental income thus far, and a $13 stock. So far, you're up $1, $5 plus $3 plus $13 minus $20. Now let's pretend the stock price starts rising. Let's say it climbs from $13 per share all the way to $16 per share. If you don't do anything, and the stock price remains at $16 per share on the covered call's expiration date, the maximum profit you could earn is the $15 strike price, plus $8 in total rental income, minus the original $20 you paid to buy the stock in the first place, or $3 in total profit. $3 in profit divided by your total investment of $20, excluding transaction fees, equals a 15% return. Not bad. But what if you now think that the stock price will keep rising? You start to think that maybe you should hang on to the stock and not let it go at the $15 strike price you previously agreed to. But does that make financial sense? Looking at the following options table for company ABC, we can now see that if we were to buy back, also known as buying to close, our original $15 strike price covered call, it would cost us the asking price of $1.25. Note that we've substituted the actual expiration dates with time periods. Here we're assuming your original covered call expires 3 months from now. I know what you're thinking. Why in the world would we give back $1.25 in rental income when we're only up $1? That doesn't make any sense. True, until you take a close look at the 1-year covered calls. Does anything jump out at you? Here you can see that renters are willing to pay you $2.15 for a 1-year $15 strike price. Not bad. But look one row down at the 1-year $20 strike price. This represents the magic of the roll-up strategy. If you really think that the stock price is going to continue to climb over the next year, why not buy back your original covered call for $1.25, then raise the strike price up to $20 and collect $1.10 in rent? Some of you might be thinking, why would I pay $1.25 to only get back $1.10? By doing so, you will only have given back 15 cents in exchange for dramatically increasing your strike price from $15 to $20. That is, $1.10 in new rent minus $1.25 to terminate your original rental agreement equals negative 15 cents. But you just significantly increased your strike price by $5. By the way, this doesn't mean your original overall investment is negative 15 cents. Remember, you were up $1 before the stock price began climbing upwards. In the event you bought back your original covered call for $1.25 and then rented a new covered call for $1.10, you would simply be reducing your overall profit on paper from $1 down to 85 cents. That is, you were up $1 before, and now you're only giving up 15 cents. So $1 minus 15 cents equals 85 cents in total overall unrealized profit. Now, what if the stock climbs above $20? Well, you could roll up your covered calls again. Assuming a stock's price is trending upwards, you can always use rents from longer expiration periods to buy back earlier rents. And in the process, roll your expiration period over and roll your strike price upwards. By roll, I really mean rolling your covered calls over into a later expiration date. And by up, I'm referring to resetting your strike price higher. So what's going on here? How is it even possible to trade in your old covered call for a new and much improved one? The answer is the secret to the roll-up strategy. Recall in lesson number 3 that I stressed the fact that time is not on our renter side, it's on our side. That is, the stock landlord side. All other things being equal, the longer the expiration date, the more the landlord can collect in rent. Why? Because more time equals more chances for the stock price to rise up to the agreed upon strike price. And because of this, our renters are willing to pay us more rent. In our example, you could buy back your original covered call that expires in 3 months and sell a new covered call that doesn't expire until 1 year from now. This extra 9 months increases the chances that the stock price could continue climbing, and consequently, renters are willing to pay more. They believe that their odds are better the more time they have. And they're right. The more time, the better the odds. In theory, you could always roll up your rental stocks, even if the stock price remained flat, and consequently, you could avoid ever having to sell your stocks to your renters. You could always buy back your covered calls before they expired and sell new, longer-term ones for more money. This, of course, only works if the stock price isn't dropping dramatically. But even if the stock price remains flat and doesn't move up or down, the roll-up strategy, or perhaps more appropriately, the rollover strategy, yields rental income year after year. Of course, it all depends on your investment objectives. Maybe you think a stock is approaching its peak and you want to eventually lose the stock at your desired strike price so you can use the cash for a more profitable rental trade. It's up to you. Before we continue on to the final strategy, it's very important you understand when and how to execute both the roll down and roll up strategies. These two strategies complement one another, and fully understanding how they work is an essential skill for any aspiring stock landlord. Please review this video again if you don't fully comprehend either the roll up or the roll down strategies. When you invest in a stock, you won't always be right, and when you're not, you'll be glad you have the roll down and the roll up tactics to further bulletproof you. All right, now on to the final strategy, the wait and see strategy. It's the easiest of the three strategies to understand, but also the riskiest, and thus potentially the most profitable. Trying to time the market or a particular stock is next to impossible. No one can know for certain whether or not a stock has actually hit its bottom or reached its top. That said, there may be times when you want to wait before you rent your newly purchased stock. For example, many times a company's stock price will rise during the days leading up to a quarterly earnings release. In this situation, buying the stock well in advance and then waiting to rent it one day before the earnings release usually results in higher rental income. Should the stock skyrocket after the earnings report, you will of course have to sell your shares at the previously agreed upon strike price. But is that so bad? No, of course not. You maximize your rental income and you'll get paid your desired strike price. In the event the stock tanks after the earnings report, you can easily buy back your covered calls for much less than you originally paid, thereby immediately realizing a profit. And you get to rent your shares again, or wait and rent them after the stock price begins to recover. Another situation sometimes suitable for the wait and see strategy arises when we find a stock suddenly near its multi-year low. With several years worth of cash on hand, for example, its current ratio is 2 or higher, and a book value per share that is attractive and in line with its industry. Such a stock may eventually reverse course and start climbing higher. If we buy the stock at what we think is the bottom and rent it immediately, we won't get as much rental income as if we had waited for the stock to rebound and then rented it. Let's look at a real-world example. Walter Energy's share price was $10.40 on June 28, 2013. On that same day, you could have received $4 per share in rental income for having written a covered call with a strike price of $10 and an expiration date of January 17, 2015. Not too bad. But had you waited to rent those same shares until July 11, 2013, just 2 weeks later, you could have rented your $10.40 shares for $4.48 per share and at a $12.50 strike price. That's 48 cents more per share in rental income and a strike price $2.50 higher. Of course, Walter Energy's share price could also have precipitously dropped and you would have missed out on the original $4 per share in rental income. Because of the inherent risks, I rarely utilize the wait and see model. I only employ this strategy in certain scenarios, such as the ones described earlier. I do not recommend utilizing the wait and see strategy until you have mastered the emergency countermeasures that the roll up and the roll down strategies afford you. Even then, I urge you to use the wait and see strategy very, very sparingly, if ever. In a few moments, you'll have the opportunity to take the final quiz. But first, I'd like to congratulate you. You're on your way to becoming a stock landlord. If you'd like to watch me as I make my own stock rental trades and rentals, please subscribe to the rentyourstock.com website. We publish all of our stock rental trades for you to see the same day that we buy and rent our stocks. We also offer another important video series entitled Buying Stocks for Half Price. To learn more about how to buy your favorite stocks for half the price everyone else is paying, please visit www.halfpricestockmarket.com. From all of us at rentyourstock.com, thank you very much for watching, and we wish you a lifetime of safe and profitable trading. Goodbye for now.